Check, check. Welcome in, guys. Welcome in. Rena, good to see you as always. Manu, you as well. I see you hitting those PayPal trades. Meant to message you privately, but I'm proud of you. Hitting those trades, getting some good money out of that. Love to see that. We'll just give it a few more minutes, guys. Everybody have a pretty good day. Actually, I need to pull up my. I'm gonna turn off the screen share. Just 1 second. I need to pull my Webull account. Here we go. You guys can all see this again, right? Just want to make sure. Livins, good to see you. Good to have you in here. No, we don't want to do a Zoom update. Not right now. Cool. Everybody can see the screen, right? Before we kind of dive in, we got 20 something people. It's probably about all we're gonna have in here, but that's all right. 30% today. Yeah, that was that's a nice one. Let me get logged in here and see if we can look at that real quick. But yeah. PayPal. Nice. Did you hit somewhere calls on the open, or let's see what is it today? Oh, swing. Nice work. Nice work. I don't swing often, but when I see something I like, definitely do. Swung some BAC overnight. That paid nice. This zone down here is the 9 moving average on the daily. And we like the close on this, and we got this pre-market action and then a gap up at the open. So this was kind of not scary, but not exciting to see. And we gapped up and it paid pretty nice. That was a nice one, but we'll definitely have got some extra time. We'll go over some other stuff, but I want to keep everybody if they're coming for this and expecting this. But welcome everybody. My name is StartedWith for you guys that don't know. One of the support members here. This is a new lecture to me, so we're all in it for the first time. I've been prepping it the last few days, so hopefully it fills the time slot accordingly and hopefully get some questions answered for you guys. The biggest thing here, this is just going to be kind of just a good foundation for you guys. The term, the phrase, the thought of long-term investing, we can't go over everything in 1 hour. And so I just want to go over some things that kind of get you guys, if you're totally new to investing, maybe you're new and you're just getting in the market, or just finally just got a really nice full-time job out of college and they have company match 401k, stuff like that. Or maybe, you're a little bit older and you just haven't invested much because you don't know or don't know how. But this is just some bare bones stuff to get you guys going. But obviously I'll try to answer all the questions I can. I'm not a big pro at this, but I do have a good knowledge base of it. But yeah, I want to go over some things, why it's important, maybe the obvious. Go over some of the account types. There's several places, if you do one thing and you max it out, you can only put in so much on a 401k, on a Roth IRA, on a health savings account. So once you fill up one, you still got money, you can keep adding to other things. You can have several avenues of investments to put your money and to make money for you. And so that's really the goal tonight, to kind of show you guys how and where to put some money, some pros and cons of each, for tax reasons. And then kind of investing on your own, whether it's buying just, a company like Google or buying an ETF on your own. Then kind of as well what to buy, when to buy, how to do it, kind of thing. So yeah, let's dive in. So the obvious, you guys, retirement, the age you can withdraw penalty free is 59 and a half. Obviously some people work past that because they want to or they have to, but I'm sure there's someone in our family, in your family, either immediate family member or relative, that they're stressing because they, maybe they had a tough upbringing, to have a really good job, they just live paycheck to paycheck. Or, what I always say, there's a difference between rich and wealthy. Wealthy are the people that invest and use their money to make money. Rich people, they have money, but they don't have a lot on the account because they spend it, whether it's foolish things, whatever you want to call it. But people have a lot of different avenues and where they, where they're brought up and how they're living. But I'm sure everybody knows someone who is struggling and near retirement, at retirement, and they don't have much to show for. And you guys don't want to be those people. We have, like I said, we have a great source here, OT, especially if you guys are young. Like, I'm going to show you some numbers and some things, and like what can be achievable if you guys are in your mid 20s, even 30s, what is possible. So I just want to show you guys that. There's a statistic In 2022, about 46% of households reported no savings in retirement. And of course, that number and that statement is kind of a broad statement. It could be a couple college kids or whatever, but generally speaking, the consensus in the US, that's kind of a big, scary number that people don't have savings or they're not saving. 26% had saved more than 100,000, and then 9%, obviously, those are probably the ultra wealthy or the people that started really early and they kept stacking that money. Denise, yeah, if you're older and starting late, that is okay. And I'm going to prove that to you because doing something and starting is better than doing nothing, because we cannot rely on Social Security being there for us, us younger folk or even older. It's like, you hear all this stuff about Social Security. It's like, is it going to be there? Is it not? And to me, I want to prepare myself and my family, if I have a family someday, I don't want to rely on the government. And so, Denise, it's never too late to start. The best thing I can say is to, write up a spreadsheet, draw up a spreadsheet, and literally, the numbers do not lie. Figure out where your money is going in and out. I mean, obviously your money's coming in from a job, but where your money is going out. There's a note here. It's like, you guys want to go eat out, lunch every day, 12 to 15, 16 bucks. That's $75 a week. That's $300 a month. $300 a month. That's a partial car payment or whatever it is. That's a lot of money, or if you're going out every Friday and Saturday, if you're young, that's fine. You want to go to the club, that's fine. But it's like, figure out where that money's going. And going back to her question, even if it's 25 bucks a month, 50 bucks a month, that adds up over time when it starts compounding. And so, write down a spreadsheet. Lambos and KC were actually, after hours, we're talking about a subject about like streaming services and where they can cut down. And like, I think it was Lambos, he said, I remember how much. I'd have to ask him. I don't know if is he in here? No, he's not in here. But how much he cut out monthly expense of just, he had a couple things doubled up and he had a couple things that are reoccurring. He's like, I just don't even use this anymore. Why am I doing this? And so write down a spreadsheet, you guys, because stuff like this adds up. Bringing a lunch, it may not be fun, but if you're like me, I cook for one. And so I cook a little bit extra at night, and that's lunch for the next day or the following day, if I don't want to have it back to back. But does this percent include 401ks? Oh, percent. Yeah, it's just basically, they did a study. I should have linked this about people that just didn't have anything in the retirement accounts, whether it's the 401k, the Roth, other stuff like that. But okay, I said, be smart, start early, even if it's nothing. Let's see if this works on a live link here. And we're looking at this together, guys. So starting balance. Your Roth, I think I have a slide on it, but obviously I cannot remember. I think the Roth starting balance, your Roth IRA, is this is the maximum on your Roth. I'll change this if it's wrong because I can't remember off the top of my head, but it's in this tab. But say you're just starting today, you can put in $6,500 a year, and let's just say, I would assume everybody in this group, or most people in this group, there's some older people. I'm in my 30s. Say you're 25, you're fresh out of college, you just got that first time job. Let's look at the numbers here. How much we contribute annually. So all the gains you make in the year, let's just say you make enough money every year that you can put this in every single year. So we're going to say, I want to max that out, my Roth, every single year. What age do you want to retire? What age do you want to pull it out? We'll just say 60. The average S&P return over the last 30 years on average, obviously we had, what was it, 2022 was pretty bad. And 2023, I think we made a pretty good run, right? If I remember right, overall. But the average return on the S&P historically is 10%, okay? And again, this is 10% a year, you guys. Again, going back to all you people that go heavy in trades, that you have 10% on your port a day. This is 10% a year on a Roth IRA, assuming a 25 to 30% tax bracket. Look at that number, you guys. $2.2 million. Does that sound pretty good when you guys retire? Sounds pretty good to me. The numbers start small, you guys, but this turns into exponential. Again, when we start saying 1% on your port, 2% on your port, when you're getting 10%, on 6,500, that's not a lot per year, But when we start, when you start early, you hit that 15, 20-year mark, like, look at this account, 2.2 million. So if you guys are seeing this, you're in the lecture, or you watch this later and it's recorded, when you guys are young and you have extra income, there's no excuse, you guys. There's no excuse to not invest for your future. And I get it. Not everybody likes a Roth IRA because you can't take your money right away. I'm going to go over that in a little bit. I don't want to skip ahead too much, but this is what's possible, you guys. And again, the 6,500 is your maximum per year. So you can divide this 65. You can divide it monthly. Obviously, maybe you don't have $541 a month, but this is just to break it down. You don't have to just January 1st doesn't hit and you just dump $6,500, because you got it laying around or whatever into your account. But I'll go over that again in the Roth. You can front run it. You can just put it in January 1st. Say, you know what? I want 6,500. I want to put it in all at once. Or you can dollar cost average, basically, which is putting in $540 every month. But yeah, you can touch backdoor. I think that might be what you mean, Hunter. So your contributions, I'll save that question. We'll come back to it, because that is a very good point. So take a look at this, guys. This is bankrate.com retirement. If you guys want to look at this, or if you're older, I'm in my 30s. If I were to start today and I put in $6,500 tomorrow, I'm going to max out every year. The auto update, yeah. So you see, look at how much that changes on 10 years, 2.1 million to 800K, because I started 10 years too late. Or if you're 45, look at that. So start early, you guys. It is boring. It is not sexy. It is not fun when you're young. But man, when you retire and money's no issue, not that you're going to be reckless, but if you want to go to the Bahamas for 2 weeks, you want to go to Fiji, you want to go wherever it is, this, 2.1 million when you're 60, and generally speaking, maybe you'll live 25 to 30 years, like, you don't have to pinch pennies, you guys. I mean, I know obviously inflation and everything else is going to change the next 20, 30 years, but like, this is where it's at, you guys. Starting early matters. You guys are 20, fresh out of college, 3.5 mil. And again, this is based on 10% return. We might have a 16% return on the S&P. We might have a 20%, whatever it is. No risk. I have a regular long-term port with 20K, mainly Mag 7. Do you recommend Star Roth IRA, just index funds? We're going to go with that. Yes. And can you roll it? Yes. Good questions. Let's just get right into it, you guys, because that's all tying in what we're going to next. All right. If you have a company, when I say good company, I mean that they will match this. Smaller companies like mine that I work for and that I freelance as well, they do not offer a contribution. But basically, this is your common employer 401k. Okay, guys. So if you're new to the game or new to get, it should be in your opening orientation. If you remember hearing this and you ignored it, you need to get back to it. You need to go talk to HR like tomorrow, because this is where it's at. 41% of companies will match your contributions up to 6%. Okay. So this is pre-taxed money. So say you make 50K a year before your taxes hit, and you're taking out X amount of dollars, we'll just say per month. Okay. If your company matches 6%, so 6% of your monthly income, whatever that is. So if you make, I don't know, 4,000 a month, 5,000 a month, 3,000 a month, whatever it is, if you contribute 6%, they will match that. So you're getting 6% for free. There's no reason, if any of you guys are watching this right now, if you're If your companies have a 401k match, you're not doing it, you're wasting money, literally free money. 10% of employers do 6% or more. When I first graduated college, I worked for Kiewit Construction, and I think they matched up to like 9 or 10%. It was a huge construction company, and you put in 9 to 12%, and they match another 9 to 12. Like that is a lot of money going in and out. And again, you have a 23K limit. Obviously, that sounds huge. Not everybody can be like, hey, at the end of the year, if you were to look at it, it's like, a lot of us don't have 23,000 extra. But if you have a very good paying job and you live below your means, you don't have 6 cars, you don't go out to eat 4 days a week, you don't spend your money stupid ways, and you have extra money, there's no reason you should not be maxing this out. Okay. One benefit, I guess you could say, is so this is pre-taxed. You're only taxed if you withdraw early, so before you're 59 and a half, or at withdrawal at the end. So retirement, you're going to get taxed on your tax bracket. You don't have to, so say you have that 2.2 million that we talked about, you don't have to pull out 2.2 million when you turn 60 or whatever. You can scale it out. You can pull out 2,000 a month or whatever, or you want to go buy a new car, or that last vacation you want to pull out, you will get taxed on that. As far as I know on the research I have done. Okay. But it's pre-taxed in the beginning. The Roth RA is post-tax. So we got to kind of say, the pros and cons of each. Some people say, you know what, I like this because it's taxed already. I don't know what my tax bracket's going to be, when I'm 50, when I'm 60. And so some people like this, some people don't have a choice. Some small things I'll touch on a little bit now and a little bit later. Pay attention to the fees. It says sometimes you don't have a choice, but a lot of these 401ks, they're going to say, all right, John, you're 25. You can take on some risk because you're young. You can take the market dips. They're going to put you, it's like a 60, 40, 20 split. So you have 60% kind of risky stuff. Maybe it's like growth stocks or something, companies that are emerging. You have 40% like maybe your blue chips, your mid-level, like your S&P 500, your QQQs. And you have 20% on lower risk stuff. It might be like bond market type stuff. And so pay attention, when you talk to HR, they're usually pretty good about it, but you just need to figure out your risk level. If you guys are young and starting out, you can take on some risk. And when we have, a year like 2022, when we hit the interest rates from the Fed and we were down, 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 yeah, it's not fun to look at. But if you're in your 20s and, yeah, the Roth might be down 20% from that peak or whatever it was, like it's not fun, but you guys have to trust the process of looking at the S&P 500 lifetime chart and seeing it just goes up. We're gonna have dips. We had COVID or whatever. We had the bubble, the market bubble was at 08, but it's like it's gonna go up, you guys, and so you guys can't freak out about it. But when you're younger, take on some risk. Ask them about. They're gonna give you a few mutual funds to pick from, but it's up to you guys to pick. But mutual funds in general are going to have a little bit of fees. Those are the fees because they're actively managed. It's a portfolio manager buying and selling, moving some things inside that basket of stocks for you. Kind of the non-active ETFs are a little bit cheaper. It doesn't sound like much, but your fees over 30 years is a ton. But at the same time, it's kind of just like, you go to get a haircut and you got to give them a tip because that's what you do. You go get some food, you give them a tip. That's just the fee you pay, the price you pay for the service. So, it's not something to cry over and, lose sleep over, but it's something to pay attention to because sometimes these fees are high. So yeah, this is a 401k, guys. Again, it's pre-taxed. It is pre-taxed. So before you get taxed each check, you can have this deducted. So basically, yeah, again, if you make 50K a year and you're smart and you pull out, 10%, say you're blessed, you can take out 10% of your check, every paycheck. So now your tax bracket, I'm gonna make up a number. So now instead of 50K on paper, you're only taxed in the year for 40K. So your tax bracket is lowered. So on paper, the government's like, oh, you made 40K a year. Okay, cool. So come tax time, that's also a great thing. Roth IRA, this is my preference, is just for me. It's not for everybody, but it is for me. Contributions are post tax. So I get paid weekly. I don't deposit weekly. I'll explain that in a bit if need be, but their contributions are post tax. So when your taxes hit, it goes to your bank, and then you say, okay, I'm gonna make my monthly contribution or yearly, whatever it is. That is how that's done. So your contributions, I'm gonna skip around a little bit. Your Roth IRA contributions last year were 6,500, and now for 2024 they bumped up to 7K. Okay, guys, so you can put in a maximum of 7K each year. Okay, so follow me here on this now. So January 1st, let's just say I put in 7K. I don't want to jinx myself on anything bad, but I'm not going to say a car repair. Say I want to get a new car. I can withdraw my contributions and not get hit. So say I have a medical emergency or something, I need to fly home for something, I need to do something. I can pull out some withdrawals over the years, penalty free. But my gain, so say I put in 7K this year and it's up to 7,000 or 7,100. That $100 profit, I cannot withdraw without getting hit. They will hit you with, you can pull it out in an emergency, but you're going to get hit on taxes with it. It's an early withdrawal fee. So the people ask, can you transfer it? Yes, you can. It's fairly easy. I did it when I left the company I was at and moved. It's a little bit of paperwork. You basically give them that paperwork, routing number, stuff like that, and you can open a Roth IRA. And so you guys just have to figure out, do I want to get taxed now and put it in, or do I want post-tax? And then, at the end, this money is growing tax-free. So gain in the Roth, wait, the gains are tax-free after 59 and a half. Is that what you're asking? So they're growing because you're taxed on this money. I think that's what you're asking. Yeah. So it's up at 7,000 right now, you guys. You can dollar cost average every year. You can split this up, but this is the max. If you can't do that, that's fine. But again, put in whatever you're able to, you guys, because going back to that chart, you've seen how much that adds up. It adds up very quickly, you guys. Another account, something people don't talk about, but it's a sneaky one, and I like it. But of the two we first talked about, those are your priority, and this is another bucket to put some money in. This is your bucket, or eggs in your basket. This is a few more eggs in another basket. A health savings account, you guys, will read this together, is a tax advantage account that can be used to pay for qualified medical expenses, co-pays, prescriptions, dental care, contacts, eyeglasses, blah blah blah. It is tax advantaged because your contributions reduce your taxable income. The money is not taxed while it's in the account, even if it earns interest on investment returns. Meaning, I have a Fidelity HSA and I trade in it. You guys, I don't day trade options. I flip shares in it. Okay. Bonus: as long as you use your HSA funds for qualified medical expenses, you won't owe taxes when you take the money out. 3 reasons why they're called triple tax advantage. They provide more tax advantages in a retirement account, such as 401ks. Okay. A health savings account. So if you guys are young and hopefully healthy, you might just have a couple co-pays for some checkups, some dental visits. But if you're older, or maybe you're not blessed with good health, whatever age you are, maybe you have some health issues, you can put in money in an HSA and say you just want to let it ride. You can max this out. If you have, again, extra money, if you have say you got 4K extra, you put in January 1st, we're rolling through May, come to June, you got a dentist appointment. Oh man, 1K, you need a root canal. Well, man, that's gonna be expensive. Wait, my investments are up. What's SPY up right now? I think SPY's up 10% year to date. 10% on 4K is not much, but it's better than zero. You guys can use this money for medical expenses. Again, my point is, I do not think it's a good idea to just leave a huge chunk of money in a savings account doing nothing. I have several sources of income and I have several places I put it. and I make my money work for me. I cannot max this out every year. I don't have that much money every year on top of the Roth and everything else I'm doing. But I flip shares. I'm very selective when I do this. I'll kind of talk about this in a little bit. But you guys can gain income on a health savings, and this can build and build and build. And again, come retirement or become you're 60 or 70 and you start having health issues, you guys, you can pull this out and pay for stuff like your hard work and that 10 to 12% a year on the S&P 500 we talked about. Like, let that just bake 12% a year for 30 years, whatever it is, if you can invest in this. And then, when you have issues come up when you're older, let it pay for it, you guys. Like, let the market pay for this stuff. Like, there's a lot people, I don't hear anybody really talk about health savings accounts, but again, it's kind of the last in line of the bucket that we want to put our money in. But this is an option, you guys. 2024 HSA contribution for families. So you guys got kids, they're sick all the time. Little Timmy plays soccer, broken bone, broken leg. I need to check if this is okay for immediate family members. I'm sure if it's under an insurance plan, but I don't want to just give you false hopes. If it says families, to me, that would make sense. But man, this can pay off some medical bills, you guys. So just think of the different ways and different places you guys can put your money. Any questions on an HSA account? Again, hopefully it's not too dry of a topic, you guys, but hopefully it turns some light bulbs on for you guys. This is my probably last or second last in line priority. If you guys have a checking and you probably have a savings, and if your savings is not a high yield savings account, what percent is that doing a year? I don't know the number. Someone throw in the chat, but it sucks. SoFi, we all talk about it. It is the real deal. 4%, 4.6% high yield savings account, you guys. 4.6% just to park some more money. So you got money coming in and out of your checking. This is exactly what I do as an example. I got money on my day job and my side gig work that comes in my checking or Venmo or whatever it is, however it's paid. And then I have a separate account that's separate from my main account because I don't want to look at it. This is my rainy day fund that you hear about. My rainy day fund, all my extra money, bills are paid, expenses are paid, I had fun. My extra money, I throw this in my SoFi account. I'm getting 4.6% a year. Okay, we've seen that, that 10% return, 4% APR a year. Like, this is my fund money account that just builds and builds and builds. I don't think about it. I just move it over. I just transfer it, and it's easy. So again, you guys, if you have a regular savings account that is doing nothing, at the end of the year, like, hey, here's your 50 cents on interest, that's not cool. Check into a SoFi account or check in with your bank and just ask them, do you guys have a high yield savings? If they do, do it. That's fine. I'm with BMO. Used to be Bank of the West. I have a separate saving just because for a mentality thing. I don't want to log in to my bank account, my checking, and see my savings and kind of know I got money. This is kind of a set it forget it, kind of a mental thing for me, and it works for me. But you guys check into this again. Like I said, high yield savings. Again, it's not much, but another example. All right, you're young, or maybe you're older, and you're like, you know what, man, I got a lot of money just sitting in my savings, not doing anything. Let's just say you got 10K just sitting there idle. 10K, right? Yeah. And you have $300 a month, and you're gonna deposit every month. 3 years, you get an extra $2,500 for doing nothing, you guys. Okay, let's just say this is my account, and I'm just gonna do this for 20 years. Look at that. You only put 82 in, you got 152. This could be another retirement account. So say you max out because you're rich and you're doing well. You max out your Roth every year, whatever it is, or you max out your employee 401k, and you need more place to park money. You got your HSA maxed out. Max out a high yield savings, you guys. Like, this is how you build wealth. This is how you do it. Again, this isn't fun after a couple years, but it's better than nothing. With inflation, if your money is literally sitting in an account and you're not doing anything with it, you're literally losing money because of inflation, the price of things rising. Like, think of what you guys can do, especially all you guys in your 20s and 30s, even 40s. Like, you're in 40s, you got 10K right now, and you want to see what it does at 60. That's this, you guys. Like, think of that. I transfer extra gain than expected from options. That's perfect. Swing, perfect comment in the chat. My options trading account, my gains every year, that funds my Roth. So January 1st, and a quick little thing going back to the Roth. So January 1st, you can, so how do I need to word this? So for the tax year 2023, so we're in 2024 right now. The tax year 2023, you can say you didn't hit your 7K limit in 2023, or so it'd be 6,500. Say you're up to 6,000, and then we hit SPX puts with flips, and you got $500. Let's pretend this is April right now. You made $500. You can deposit for the 2023 tax year up until tax day. So was it April 15th? So up until April 15th this year, you can make deposits in 2023. And starting April 16th, whatever you put in goes to 2024. So regarding swings comment, yeah, every year my gains from my options trading, I pull it out, I withdraw it, and I drop it. Every single year, I just drop it. And I make that money that I made, I turn that, you always hear me say turn profit into profit. So that money I put in is money I made. It is not money that I had to, well, I worked for it, but you know what I mean? It is gains money, and it goes into my Roth, and then it just rolls tax free. And then I flip shares and I trade in this. And so guys, you got to get that snowball rolling of your account, because when you do, you've seen that chart. Like, you don't want to be relying on, stipend social security checks every month. Like, we didn't have Discords. I don't know when Discord started, but it's like, we didn't have that years ago. Now that we have this, like, we are so blessed to have this. And so we have all these avenues to make money. Yeah, does anybody have questions on high yield savings? It was pretty basic, but again, talk to your bank. Say, hey, do you have a high yield savings? If they do, you can do it. But again, I do the SoFi thing because it's a separate account. Obviously, I can log in and see it, but it's just a mental thing. I don't really want to know how much is in there. I just want to know I put in so much per month and I do it. When I start trading, I deposit 2K in the Roth IRA and lost it all. I thought it was individual trading account. Nice, Rudy. Yep. iPhone, you can do options in your Roth. You need to get approved and you need to be good, because you put in 7K. What was that iPhone? You put in 7K and you're an idiot. You yellow it and you lose it. You can't just keep adding to this. Like your individual account on Webull and Robinhood, where you blow 7K and you're rich, so you put 7 more in. Like, you hit your contribution and you lost it. So like, you guys have to be smart. This is a long-term slow gain. I mean, obviously I can't stop you from trading in it. I admitted I traded mine because I'm confident what I do, but like, guys, this is long-term. Like, you just need, this is your nest egg. This is the food on the stove, just a slow simmer, slow boil. You just let this cook and then you get paid when you're done. You just let this go. Your day trade options, take those big swings, 12%, 50% a day. This, you guys, just let this simmer. This is literally, this is your nest egg. To not be working, I don't want to say it. You don't want to be a Walmart greeter when you're 85. Maybe you do, but you don't want to do it because you need money. Okay. Those guys are great. They're the most polite people in Walmart. So I shouldn't have said that. That was kind of mean, but you get my point. You don't want to be working when you're 80 because you have to. Okay. One of our last few slides. Again, don't keep all your eggs in one basket. This is kind of what I do. So I have my main job, my side gigs, my freelance stuff, and my day trading, and I pay my bills. Bills are paid, rent's paid, car payments paid, fund money. Okay. You fund the Roth. And these two are kind of interchangeable. Your HSA, your high yield savings. But it's not like, you your income and you go party, you go to the club, oh, and you're late on your electric bill, or you can't make your car payment now because you went to the club. It's like, be responsible. I get it. We're young, we want to have fun, but it's like, you know, I have an old man mindset. Like, think about what this can do for you guys, 10, 20, 30 years from now. So pay the bills, then have some fun, go out with some friends. You got extra money, fund that Roth, fund that health savings account. Okay. And then when we're done, meet me on that private island, you guys, because we're gonna be drinking pina coladas or beers or whiskey, whatever you guys want to do. But that's what it's about, you guys. So you may have any questions on my stupid slide? No? Okay, good. All right. So again, younger, a little bit more risk. I don't think you guys will be able to click on these later. So if you want these links to look through this, send me a DM and I'll get them to you. When you're younger, again, your HR department, if you're going to invest with your employer, it's kind of a 60-40-20 split. You want some more risk. When you're older, you want to take a little bit of risk off. You don't want to be, you don't want to be in your 60s and have heavy QQQ, like full port, your whole investment is QQQ. And then we have a year like COVID or a year like 2022. Like that would be not fun to sit through that. Like maybe you held and wrote it up and you recovered, but it's like, you don't want that much risk when you want to pull that money out when you're getting ready to. You want safer stuff, less volatility. Okay, you guys. Gonna open a few of these here. That's just the comparison between an ETF and a mutual fund. There's a couple key points. An ETF, you can buy, usually you can buy fractional shares. So if I show you some ETFs and it's like $200 a share, you're like, oh, I don't want to do that. And just you can buy fractional shares on an ETF. Just like, when Amazon was in trading a couple $1,000s a share, it's like, well, I don't want to, I only got 700 or $7,000 to invest this year. It's like, I don't want to buy one Amazon share for 1,000 and that takes up most of my money. You can buy fractional shares. Okay. Mutual funds, you can on some, but most it's a fixed dollar amount. And sometimes there's a minimum buy-in. Okay. Another thing, ETFs, you can trade in and out every day, real-time pricing like Apple, like Amazon, like whatever. A mutual fund, that price is traded once a day. So if you get it in, you get in a mutual fund, I don't know what it is. I don't have a ticker in front of me, but it's like you buy that price with everybody else. That closing, I think it's the closing price that day. If you want to sell 5 days later, you put in an order, and when that next day opens, that's when your money settles. An ETF, you can trade and flip every day. And so just some comparisons to pay attention to, you guys. Typically, the fees as well are different, but yeah. Portfolio composition. All right. Why is it doing it? So say your company does not offer 401k or Roth, and you say, you know what? I'm not comfortable trading on my own. I want to just put money in and let it ride, like he said. One case said, just let it ride. VTI from Vanguard is a total market ETF. You can see year to date, the S&P 500 is up like 9%. This total market ETF did 8.4% as of January 1st, or from January 1st till today. And so this is an ETF of the total stock market. There's 3,717 stocks. So Apple did have a down day today. If Apple has a down day today, AMD might be up. You're going to ride the wave of everything combined, whatever these are. We can't go over 3,700 stocks. Okay. You can literally just do this. If you're like, you know what? I want the full market. I don't know how to invest. I don't know what to do. VTI is a total stock market ETF. Buy and forget it. Buy and ride it. Performance, does it have a annual? Yeah. Okay. So 2023. So like I said, 2022, that was a bad year, 20%. The whole market was down, obviously. And then look at we rallied. So you can see historically, you know, 30% gains in a year, 30% for doing nothing, 28% doing nothing, 24% doing nothing, just letting it ride, you guys. Again, this is in your Roth. This is what you do. How would you invest in a Roth? Good question. Slowly, hopefully, I get to that or discuss it. Go to this Vanguard page, swing, and I keep seeing it. I'm scrolling too far. Sorry, doing this in real time. Right here, this is kind of, this will tell you. We can go over this privately in DMs if there's more time. I don't want to run out of time, but this kind of tells you, it's a large market cap. You're getting a little bit of everything. It's a blend. Growth is a little bit more risky. This is kind of a medium market performance thing, stuff like that. And you can have small caps down here. You can have small cap growth, but you got to kind of poke around a little bit, you guys. There are so many in here on Vanguard, on Fidelity, whatever your broker is. Vanguard is nice because look at this expense ratio, 3%. That's like nothing. Fidelity has 0% expense ratios on stuff, but you guys you got to poke around. Because there's a couple examples. So yeah, if you want some all-in-one, go for your VTIs. If you're like, you know what, we play S&P, we play SPY every year or every day, I mean, and you want to track this. You're like, you know what, I'm going to buy and forget S&P 500. I'll check back on December 31st. VOO is your best friend. It tracks and it follows the S&P 500. Swing, if you want a little bit of growth, VOOG. And again, when you guys click on these, I should have said, let me go back really quick just to show you. Trying to get to the top, sorry. So you want to start clicking around. No, we want VOG. Hang with me here. You want to look at portfolio composition because that is literally what is inside of it. You want to know what you're buying. If you're like, hey, I'm getting the S&P 500 growth, let's click and let's look on here. I bet it's big tech. Where does it say fees, distribution? Did I miss it? And of course, when I'm live, I can't find it. It should say what's in here. Damn it. There we go. All right. So this is showing, what is this showing? Not the top 10. This is showing everything, or would show everything. So there's 200, or no, it's page 227. So it's top holdings, you guys. If you want to get VOOG growth, you're saying, I like Microsoft, Apple, NVIDIA. So this is big tech. So Microsoft, Apple, NVIDIA, Amazon have a bad day. This ETF is going to have a bad day because look at 13% of this holding. So 13% of your money is in Microsoft, 10% Apple. So look at, it's under portfolio distribution, holding details, you guys. You want to see, you don't want super, super risky stuff. And I want to show you an example. We're running behind, but I want to get to everything. Small cap summer, small cap VBR, VBK, you guys are getting hit. Stuff like IWM. This is not having a good day, a good year because of interest rates, you guys. But when the Fed announces a cut, signals a cut, well, let me say it. If Powell signals a cut, and it's not because of economic downfalls, when he announces a cut, small caps are going to fly because this is small companies right now. They're borrowing money and it's more expensive to borrow. Interest rates, think about that. So these guys are hurt right now. So your IWMs that we talk about on trade floor, this is going to probably be the outperformer at the back half of the year if we get rate cuts. If we get rate cuts because of a good decision or good reason, meaning like, hey, we hit 2% goal, inflation they talk about for 2 years, we hit that, small caps are probably going to be flying. Okay. Talked about risk. Let me see here. Everybody knows Kathy Wood, right? Kathy Wood. She's the best trader ever. ARKG is one of hers. ARKG. 2019, not 2020 is COVID, 2018 and 19. Everybody wanted in this. Everybody said Kathy's the GOAT. Oh man, everybody jumped in. Not gonna lie, I was in on this run for part of it. Look at this decline, you guys. My point is, do not follow the hype and do not chase super, super risky stuff. Year to date, so the S&P we said is up 10% this year. And Kathy, if you full ported that 7K in your Roth and you said, hey, I'm buying this this ARK ETF, you were down 27% and we're only halfway through the year. So you're down 27% and the S&P is up 10%. So my point is, you guys, you can buy and scale into stuff like this when, let's get out of this. Someone was asking about risk. This would be, if you're young, this would be about like 10 to 15% risk in my port. Okay. Let me see here. I'm just going to click on one to get it going. Oh my gosh, just let me. Okay. So this is considered risky holdings. Maybe not this one. What were we on? ARKG. Yeah. So again, you need to look at the holdings. You are betting on these companies. These are probably medical and bioscience stuff, pharmaceutical. Like you're betting on forward progress with drugs, whether it's like a diabetes drug or a cancer drug. That is what you're betting on this. And so this is risky because nothing is promised. This takes years to come up with. So stuff like this, you guys, you don't go 100% of your Roth into stuff like this, even if you're young, because right now you're sitting through 25%, you guys down. So this is whoever asked that question in the chat. This is where you scale a little bit. You say, you know what? I'm young. I want to take some risk. And I think maybe that some of these companies can start to perform. Where can this chart be in 30 years? I don't know. Maybe it's $15, $5. Maybe it's way up here, a couple $100. But Apple in the 90s, the S&P in the 90s when it was tiny. It's like those people that just bought and hold for 30 years. This could be one of those things, you guys. But again, you don't go full on risk into this. This is a very small percent, like 10% of your portfolio. And again, it can be a buy and hold or a buy and a reasonable stop out on something like that. A fun one I would point out. I've done this a few times, so I don't buy crypto like directly, but when I see things like Grizzlies, looking at Bitcoin, buy some dips here, and I'm looking at a summer run. I'm just making this up, but if he starts saying, hey, I'm looking at a summer run, I'm looking at stuff like this, FDIG. Okay. If you don't want to trade options on it, here's what you can do. Crypto industry. Let's look at crypto. Okay. So he's like, miners are going to go. I like coin. I like Riot, whatever. Right here, guys. You can buy an ETF and follow kind of what Grizzlies is thinking maybe for the summer or for the winter, whatever he says. You can buy an ETF like this and say you don't want all your eggs in one basket. You don't want to be all in on coin or Mara. Look at coin, Mara, Riot. All these names, you guys, Bitcoin related, you can ride the wave of Bitcoin and it probably performs and follows Bitcoin, because if these guys are moving, if Coinbase is moving, so is your ETF. That's a pretty big holding, 15%. But again, know the risk. If like these top 3 or 5 have a bad day, this ETF is not gonna have a good day either. So, you can be in, I'm not saying do this long term, but this can be an avenue. If you don't know a damn thing about Bitcoin or crypto and you're like, hey, I want to follow Grizzlies, but I want to do it in my Roth and maybe safe and maybe safer, buy an ETF like this. This is just another example, you guys. So you got to do some poking around. I have Fidelity. I love it. It's super. I'm not logged in right now, so it won't show much, but under planning advice, they have tons of scanners you can look at. I mean, you can look at a bunch of this stuff, performance and risk, PE ratio, stuff like that. Like this is where it's at. Vanguard, Fidelity, stuff like that. I think I clicked on that one, but yeah, FDIG. Yeah, that was one of them. Does anybody have any questions? It's kind of a lot. Take some screenshots. If not, if you guys need these links, check out IGV. Norman, is that a ETF? That's running. Damn. Sexy double top. If anybody got that. ETF details. Profile. Expanded text software. Interesting. Good find. I need to find what is inside of that. It doesn't tell me. DUI. If not, good to have you. Hey man, unmute your mic. Do you have anything to add? Anything you change with presentation or how you invest on your Roth or whatever you have? Like what kind of avenues do you invest in? Let me know, man. Unmute your mic if you want to. PEY. NASDAQ dividend. Yeah, see, that's why we got smart people in here. So we talked about kind of 60-40-20 split. You can kind of go small cap. Let me find, now that that's a dividend, I've watched this for everything, you guys. Dividends. This is kind of a fun one too. Let me find it. SDIV, super dividend, or SPHD. These are companies that pay really high dividends, either monthly or however they do it. And you're just buying, again, just like the S&P 500, you're buying a basket of stocks of companies that pay dividends. And so these moves, you guys, like they're not that big. 20% on those lows. It's not going to make big moves per day. But like this is another avenue. You can put 15 to 20% some dividends and just let those dividends stack up and roll and roll and roll. Good call out. Actually, dive and look at that now that you said that. Yeah. PEY. Invesco high yield. I like that. I'm going to add that. Nice job, Banana.
What's up? How are you, man?
Doing good, man. How are you?
Very well. Super interesting lecture. I love it. There's so many things where you can diversify your portfolio that it's kind of overwhelming.
Yeah, man. It's like, to me, I just don't want money sitting on the side. I mean, I get if I got upcoming expenses, but there's just a lot of ways, man. And
Yeah.
people, it's cool to grow the port and all, but it's like we've talked about it. That money's not your money until it's doing something for you, whether it's
Yeah.
buying
You
your dream
asked,
vacation or whatever. It's just the money on the screen. But
for us, I'm from South America, and we have a sort of different traditional way of like I don't use the 401ks or IRAs or anything like that.
mhm,
Um, we believe in old-fashioned, invest your own money will make you more money.
mhm,
And normally we have this bad habit that we normally we pay everything cash. So we own like our cars, we own our houses. We like to be owners of our stuff so we can have our equity, and we don't depend on credits. So
you
uh,
don't carry a bunch of debt, then I love that, man. I love that.
yeah, so that's just a different way to approach it. Like of course, there is a huge advantage of using the credits that you have and the
Mhm.
debt and how to leverage with it. But normally, I rather have my portfolio and invest and manage it myself.
Yep.
And that's the way how I allocated my profits. And I have like certain accounts that I use in wealth management that I don't touch. And that's like
Mm-hmm.
my emergency fund. And
Uh-huh.
I have an emergency fund that it will cover me for 2 years, everything, all of my expenses paid. So I calculated normally what
That's so smart, man. I'm glad you
my
said that.
wife and I, like how much we spend on everything that we do.
Mm-hmm.
And in case that we have any problem with, cash flow or sickness or whatever,
Mm-hmm.
there are 2 years that are completely covered. And that's something that I have with low risk in
Yep.
an in a wealth management uh, company, and it's accessible anytime that I need it in case of anything.
Man, that's so
That's
smart.
a good
Actually,
idea. That's always, for people who's making money trading, like they say, like, okay, I have everything on my checking account. Start making, start preparing for the future a little bit. It's not that you need to just save and don't live, but you never know what's going to happen. And maybe you're making a lot of money, and sometimes you can have a bad, sort of wave, and then you're not making that much money. So you need to
yep.
prepare and save a little. And that emergency fund, it's something that it's a non-negotiable. You don't touch it. Doesn't No matter what your current position is, you just don't touch it.
I love that, man. Yeah, like you said, it's like you don't know, God forbid, car accident injury from anybody, or like when COVID, like look how many people lost their jobs, and it's like we lost our people lost their jobs, and it's not like we have instant money, right then and there, and it's like you got to dip into that, like the rent, the landlord, he don't stop knocking, like they want the rent, the car payment, like some of that could have been, on a grace period. I get it with COVID, but it's like you just don't know what's going to happen, you guys. And so that should have been added here. That's a very, very good point. That rainy, not a rainy day fund, but emergency fund. You said what, 2 years, Empanada?
You can make, like, normally the rule of
six
investment is
months,
one
right?
year. Like
Or 1 year?
you need to have 1 year of all your expenses covered. So if you need to find a new job, if something happened or anything, but
Mm-hmm.
if you're making more money, have 2 years, free of any stress on any of your expenses is pretty good.
Yep. Love that. Love that. Good point.
Yeah.
Anybody can jump in if you guys have other points. I got one more slide, but it's open mic session if you guys want anything. But just want to wrap up. I'm in no hurry, so hopefully you guys aren't either. But some things. I talked to Tilly a little bit about some long-term stuff, and again, the term long-term means something different to everybody. But if you guys paid attention to like basically his newsletters from like December, he was calling. I mean, BBY Best Buy is a newer one, but like AVGO, Google, Meta, Nvidia, like he was, you know, talking about that in December, January, and we've seen those runs that all these have made. So I'm not going to say buy these today, buy these tomorrow, buy these all in, but these I felt maybe Empanada you can provide insight to, but these are some names that are proven and that will have long-term longevity. But again, um, if you're going to buy single shares on your own, again, it's never just, oh, I'm buying Google tomorrow and that's it. It's for me, like if I have, say I only want to invest, I have 7K to invest, and I'm looking, I'm going, okay, I got 7K. So Google or anything, you want a dollar cost average, DCA. You see people say that. It's like you want to scale in when it makes sense and think of it as a sale. You know, if McDonald's on one side of the street has a Big Mac meal for $12 and across the street it's for $8, it's obvious where you guys are going to go. You're going to go where it's cheaper. And so when we had, I'm going off on a tangent. This chart's going to be ugly. All right, there we go. Weekly. 2 weeks ago, when we sold down, this is the SPY, when we sold down to 20 MA weekly, which we have not broken since October 2023, I loaded in the Roth SPXL shares. Those are leveraged shares. So if SPY moves up 1%, I get 3%. I loaded the freaking boat. I messaged River. I said, if we close at or under 500 this week and we're near this 20 MA, I'm loading the boat. Okay. This to me is a Black Friday flash sale. The market is going to keep going up unless something happens in the economy or financial conditions. Like this is a sale. This is your McDonald's for $8. But now you want it here. Now you want it at $12, that meal. It's like, buy the fear when it makes sense, you guys. I loaded shares in my Roth and I flipped this last let's say Tuesday. I think I got 12% off this move. So when SPY moves a certain percent, if it moves what would that be, 4% from this bottom, that bags me 12% in, however many days that was. So my point is, when you guys buy stuff, do not go all in, especially if you're starting out. Like if you just want a dollar cost average into SPY, buy a little bit on this dip, and then when it makes sense, or if financial conditions, dollar cost in, because there's a few things. You don't want to catch a falling knife on stuff, and it's got to make sense to you guys. You don't, and it's a long-term hold. So if you buy a starter position of SPY shares, like, you know what, this is a 20-year hold for me. If we have a 3% red week on SPY, you should not be freaking out in your Roth IRA. Like if you're holding calls that expire in 2 days, you're down 8%, freak out. But shares on the Roth that are meant to be held for a long time, you don't care about, 3% weeks. Okay. Like this, was this last year? What year was this? Random story. I was in Iceland, October 2022, and I found some Wi-Fi. I knew the markets were bleeding. I loaded my port in an RV on Wi-Fi in Iceland because I bought this fear in October 22, because I knew over time the market will go up. Yes, it's ugly. And if you bought shares up here, it's ugly, but it's like you buy the fear, you guys. You buy when it's on sale and you dollar cost average in. So my point here on buying on your own, talk to people who are knowledgeable, pay attention to Tilio's newsletter, scale in, whether you like the energy sector, XLE, Chevron, Exxon, financials, but you don't, again, you only have 7, if it's referring to your Roth and you're just starting out, you only have $7,000. You don't just take $7,000 and buy Google tomorrow. And then over the years or next couple months, Google's down 6-12%. It's like, and you have to live through that. It's like dollar cost average, set yourself up. It's the same as if you're buying the SPY ETF and you say, you know what, I want to buy a little bit every month. The first of every month, you just buy a little bit no matter what it is. That's kind of what people do when they dollar cost average. Again, small caps for rate cuts, probably the winner in the back half of the year. But again, it's got to be rate cuts for a good reason. Pay attention to Tilio's newsletter. That thing is packed full of knowledge. He's not doing it just to do it. He had mentioned Best Buy. You guys should read into why that kind of piqued his interest, and some of these other names that he's talked about over the weeks and months. And again, that SPY weekly chart, everyone was super, super bearish. I loaded the boat. When things get ugly, guys, the first thing I do, I go to a weekly chart and I say, okay, where are we at? Where the hell are we? It's like this weekly 9 broke, yes, but the weekly 20 has not broken since October last year. It's like you buy that fear and you get rewarded. You don't buy the top. You don't buy people's sells on a breakout. You don't buy Kathy Wood's ARK investments because it's up 1,200%. Does anybody have any questions? FTXL is my bet for semiconductors. FTXL. Just leverage or just as is? Nice. You guys got some good ones. I need to check into that. Nice one. Rudy, give me 1 second. Anybody have any questions related to the lecture? I'll mute your mic, or if it's more of a private thing about money or something, send me a DM or Tilio. Like, guys, if you guys look at that, like Tilio is he obviously is super, super smart. Like, he's the definition of an investor. He watches word for word the FOMC meetings. He listens in on these earnings calls, and like that dictates to him what he hears if he is an investor. Yeah, he plays the chart as well and plays setups and stuff like that, but like he is playing, and when he puts those nuggets of information in those weekly watch lists, you guys need to follow and pay attention because they're packed with so much information. He's not just doing it to do it, you guys. And so he pays attention on all those earnings reports, and I'll message him and say, hey, what do you think of this? He's like, oh, it looks like growth outlook or this outlook or revenue this or whatever. It's like it's slowing. I might wait. Where he's like, no, I like that earnings call. It's a good time to scale in. So if you guys have a plan and have some, detailed questions, ask him, and he will always take the time to answer them for you guys. Rudy, what is your position, brother? You're in. I'm gonna take a look at this chart for Rudy, but if you guys gotta go, thank you for attending. You gotta leave, no big deal. I don't want to do much charting, but he gets a freebie. You're in weeklies. Doesn't tell me anything. Are you in profits? Did you swing some in profits? Did you buy the bottom and you're worried? Where are you at? You know me, I'm gonna start on the hour and figure out where we're at. I got in at 44, you're swinging one. I'd say you're sitting good. You know me, I draw my zones. This definitely stands out to me. Something, it's probably a big zone. So I'm grabbing this zone here, Rudy, if you're watching. Actually, we'll draw it red because we want it to be resistance. So as long as we open under this, I think your swing is good. This is a 1 hour time frame. So I grabbed it here because it's the top of this little zone here. Wicks here, wicks here, wicks here. This zone is kind of the pivot recently. You see when we sell down hard, we push up, we rejected, reject, push up, we tried, rejected, over it. This was now support, we pushed under it. So now your game plan tomorrow, a modest stop, 43.6. Again, hard stop, kind of at your entry, man, 44. I wouldn't let it go, at minimum, let it go break even, but you come down. And now we got your stop loss, your profit target should be 43 flat and 42.6-ish zone. Because this zone here is lined up with pretty much everything. So as long as you stay under that, I like that, man. I might if I take it, I'll give you credit for sure, dude. I kind of like that. So send an alert. I'll probably have to move this bottom alert here, but set some alerts there and look for that. VST, and that is the last one. What are you in? Rudy, you're welcome. Chat with you tomorrow. What are you in on this, Norman? They had earnings tomorrow. 90. Add to the S&P. Nice. Are you in it? Better be in it if we're checking it out, man. We just looking at charts for fun. I mean, we are, but better be loaded. Put your money where your mouth is, brother. Just teasing. All right, you guys. I appreciate your time being here. Hopefully you got a little bit smarter. Hopefully you learned something again. DMs are open. I will try and answer them best I can. I'm only doing DMs probably the next morning because, not to be rude, but I start answering DMs late at night, and 5 minutes turns into 90 minutes, and then it's super late, and I need a little time to decompress at night because trading and work and lectures is a lot. So any DMs I get, you guys, tomorrow pre-market, I got you. Don't you guys worry. But I appreciate you guys being here, all the regulars, all the newbies. Again, hopefully this helped you guys, but man, start investing, you guys, because it's the real deal. This is it. You guys don't need any more motivation, all you 25-year-olds. No more motivation. No more motivation, guys. If you want to be a millionaire, if you're 25, you want to be a millionaire when you're 53, get this shit going. No excuses, you guys. And when you're a millionaire, I want you to call me and take me on a private flight because I helped you. But do it quick. I don't want to be dead. All right. I'm out here, guys. Screen share's going off. Everybody have a great night.